So agenda for today is very simple. We usually get a lot of founders asking us, how do you reach out to VCs? What is it that VCs evaluate? And why is it that you invest in only 5 companies and bunch of these other things, right? So today the entire idea is to demystify this for them.
All businesses are great business, but not all great businesses are VC-fundable. So while building a 100 crore business is non-trivial and you have done that, kudos to you, but a VC may not back that, right? And that's where a lot of founders have that disconnect. Because a 100 crore business at max could be, say, 1,000 crore valuation in a very good case, which is like, 120 million valuation. Even if the VC owns, say, 20% of the business, they'll make 24 million out of that, right?
If it's a good idea, valuable problem, 10 more teams will come, right? Why are you best suited, right? How do I answer that question? VCs look for a replicability in the GTM motion, right? So have you figured the right customer? Can you reach out to them in a replicable, scalable manner over the course of 18 months post-funding? I don't know, less than 2% of market value has been created by VC-backed companies, right?
So you want VCs who are there with you during downtime, because up times when things are going well, everybody and their mothers will be like cheering for you.
I think storytelling kind of makes sense if you have the substance beyond it. So I think it's it's not like of course I've seen cases where it's just storytelling and there's no substance. So that is also not good.
Maybe I'll touch upon some topics that are a bit controversial.
Right.
Hello, and welcome to another episode of Prime Venture Partners podcast. Today, we decided to do something different. We don't have any of the partners here, we don't have any founders. We thought it'll just be the three of us, me, Gaurav, and Pankaj, and me asking them a bunch of questions that I'm sure most founders will want to know. So, welcome, Gaurav and Pankaj. They can cut it. But yeah, so welcome Gaurav and Pankaj. So agenda for today is very simple. We usually get a lot of founders asking us, how do you reach out to VCs? What is it that VCs evaluate? And why is it that you invest in only 5 companies and bunch of these other things, right? So today the entire idea is to demystify this for them. And let's see, have fun. So maybe I'll start with Gaurav first. I am not sure most of you would know. Gaurav has been with us for the last 7 years now. 7 years, is it, Gaurav? Yeah. Or 8?
7.
7. Okay. And he has operating experience before this. So how to build a startup 0 to 1, 1 to 10, he has seen all of it. So maybe I'll start with something a little bit more personal. You came from an operating experience to VC, right? What was the most surprising thing for you?
First of all, thanks a lot, Shivani, for having me. It's an honor and a privilege to be sitting across the table with you. Right. Yeah, so when move to VC was not planned move. It all happened through sheer chance and connections. So for me, before moving to VC, I'd spent about 4.5 years working with 2 early stage startups. I see the journey from 0 to 1 and maybe 10. Founding till Series B, call it whatever. So for me, the first thing that was surprising was the pace at which things move here. Right? I remember I joined in May, and the first deal that we did that year was around October. So maybe for like 3-4 months, I was like clueless. Am I in the right place? Am I at the right place? Am I doing my job right? And then, so gradually you get to know that, this is not as fast as things would move in a startup, because there you do things every day and you have like very fast feedback loops. So that was the most surprising thing for me. Second was, of course, from a team point of view, right? Startups generally start small, but gradually grow up and teams become bigger. Here we have a very small team. There's 3 partners and me, right? So the team was very small. So that was also a little bit of thing for me to adjust into. Like, how do you work with a small team, and that too where people are like far senior than you in terms of work, etc. Right. So those are 2 things which took some time for me to adjust. Right. And as I spent more time, I realized that like doing deals is one thing, but feedback cycle in startups is not 3 months, or in VC is not 3 months or 6 months. It is in fact like 7-8 years. Right. You do an investment and you only get to know about them, the results of those investments. You start seeing some like signs of that in the first 3 years, and then actual results happens in like 6-7 years, right? So it's even a longer feedback cycle than what you would think otherwise.
Fair. And what would you say, how many startups would you have spoken to in the last 7 years?
More than 1,500, I would say, that I've spoken to.
That's
yeah.
a conversation.
Conversations, yeah. I mean, in
Yeah.
terms of like just looking at next, it would be maybe like 4,000, 4,000.
Wow, that's a lot of startups. And you have how many investments?
So since the time I joined Prime, we had about 16 companies, 17 companies in the portfolio, and now we have about 55 total that we invested in. So like,
हमने भी कुछ किया ना भाई, like
no, what Prime, right? I did not see about me. So I'm not counting on my personal investment.
Okay. No, great. So Pankaj, coming to you. So for everybody who knows Pankaj, you would know him as this guy who is always cracking jokes, is very, out there, outspoken. But in front of a camera, he's very shy.
I'm not. This is my fifth podcast.
Good. So maybe a little bit about you and your journey at Prime.
Yeah, so similar experience as Gaurav, maybe a few years more on the operating side of it. Again, 0 to 1, 1 to 10, have seen that cycle starting with, companies when they were barely at any scale to kind of seeing them, grow in a short span, right, to massive scale. And, the most, I would say, I don't know, remember the right word for it, but the most impactful role that I think, if I were to summarize, was being, early to quick commerce in terms of executing, setting up the whole thing. Of course, with a very, very fantastic team at Swiggy in the early days, but that was really fun. Even before that, right, all the journeys were had its own kind of charm and learning, and I think played a very formative role in my professional career and got me here.
Yeah. So I think it was Swiggy, Rupeek.
Yeah, so Swiggy, Rupeek, before that was Urban Ladder, was slightly scaled up. Then before that, Taxi for Sure, which got acquired by Ola back in the day. So all mostly consumer place. Yeah.
Yes. I think you saw the entire startup ecosystem evolve, right, from Taxi for sure. Great. No, maybe coming to the agenda, right? So I think one of the things that founders often ask us wherever we go for events, for just general meetups, is how do you reach out to a VC? Like, what's the best way to reach out to you guys? So, just to put a few things in context for our listeners as well. So, as Prime, and this will be true in any VC fund, right? We would get top of the funnel in inbounds, outbounds, everything included around maybe say 5,000 deals a year, of which I think we do our best to at least speak to 300, 400, or maybe more, 400, 500 each a year, and finally invest in 5 companies, right? So that's the way the funnel looks. So if you have to stand out, there are a few tips that maybe even these guys can share, we can share with you. So maybe Gaurav, let's start with you. What would you say is the best way for a founder to reach out to Prime or to any other investor, right?
So as you said, right, every investor is like flooded with, deal flow, right? And there you have to you have to prioritize, right? I mean, in a day you may come across 15, 20 deals, but you can't talk to all of them as much as you'd like to. So you have to prioritize, right? And typically the way prioritization happens is if something has come through referral, and that referral could be through another investor, through one of their portfolio companies, through a friend, right? So that takes priority over everything else, right? So if you want to reach out to someone, find a way to get you a referral to the person that you want to reach out to, right? So that's the most important thing. Second thing I would say is, see, in a small fund like ours, where the team is pretty small, we're like a 5-6 people team. You can reach out to anyone and through referral or even otherwise and make it a conversation. In larger funds where you have a larger team size, do some work to figure out who is the person who looks at the area that you're building in, right? And it makes sense to reach out to that person, right? So that is when I think referral works the best. Second, if you can't find referral, right? And if you really have to do an cold outreach, make it a little more personalized. And by personalized, I mean like look at what their thesis is, look at what they've invested in, look at what they've spoken to in other podcasts or on their blog posts or in their thesis documents, and make some reference and connects to that. So that kind of is a little more warm than pure cold and bound, right? Because you know that the person has done some work, knows what we invest in, the kind of startup that we look for. So that gets some more precedence over pure cold and bound, right? So that's, I think, the best way to at least reach out. Best is, of course, to referrals. And if you're a founder, I'm sure you'll find somebody in the portfolio who can refer you, right? And founders generally are like quite helpful to each other. So you'll definitely find somebody in our own portfolio, a founder that you can reach out to and like have a conversation who can refer you to us. If not, at least it should be a little more personalized, outbound, cold outbound. And then this is not just for us, for every, I mean,
Yeah, for every VC
for
out
every
there.
VC, it works the same
Yeah,
way.
yeah. Got it. No, but I think one thing is right, like the Bangalore founders, Mumbai founders, even Delhi founders find it easier to get these referrals because more likely or not, they'll have some friend or colleague who knows one of the VCs, knows one of the portfolio companies in Bangalore. More often than not, you are part of some startup, right, which will be funded by a VC. So it's easier. But any recommendations for even the tier 2, tier 3 guys, like maybe who somebody building, maybe say in a Hubli, Dharwad or your hometown, right? Like Begusarai. Any recommendations there that can help them if they don't have the network?
I think it's personalized outbound is, I think, what should work. I don't see, I mean, that is what, I mean, you can do cold outreach, but as I said, it's very hard to like filter signal from noise. Even if you have to do it, I'd suggest that if you have to send something, make it very crisp. If you have to send a pitch deck, don't send a 20 slide deck because in cold outreach, you know, nobody will read that. But if it's the one pager, quickly summarizing what you do, and if it's interesting enough, people might reply on that.
Yeah.
I'll just add one thing to what Gaurav said, right? One is obviously within the fund who you should reach out, obviously makes sense, right? But even the universe, right? Now you have like so many micro VCs, so many, all crossover funds, right? Investing across all stages. It's also important for you as a founder to figure out which VCs for you to prioritize, right? Of course, VCs are dealing with their own volume, right? But for you also to try to, talk to everybody is probably not feasible, right? So it probably helps to, have your own shortlist of VCs, right? Who are 4, 5, 6, maybe some number, right, of VCs that you would want to talk to. And that could be a function of maybe, your broad area in which you're operating, the VC has taken a bet on, they have published stuff, right, on the topic. Or, of course, like I think, even from being a tier 2, right, that could be a factor, right? Because if you are speaking about a domain or some area that that is top of mind for them, right? Again, your conversion, again, you're also solving like for acquisition, the founders are solving for conversion, right? Even on this, you're actually solving for conversion, and the idea is to get to the first conversation, right? First call, first meeting, whatever, right? Probably helps rather than bombarding. Of course, it has to be personalized and all, but you can also direct your efforts to where you have highest probability of getting a response, right?
Yeah.
And one thing I think that may not be an issue with tier 2, tier 3 founders that you ask, but typically founders sort of say, okay, let me talk to like a partner level person or a GP in the fund, right? They're kind of dealing with a lot of things, right? They have their own portfolio to manage, so they are not always, obviously not true, but they are not necessarily 100% going to be your champion, right? Or would have the time to even take the call, right? So even if you're getting that response from an analyst associate and obviously, anybody beyond, you should, I mean, if you're convinced about the funds and what kind of partner they can be for you, you should take the call, right? We see various founders who are that, okay, no, I want to just talk to the partner and I'm not going to talk to anybody else. Probably not something that I would recommend, right? Even when our portfolio is going out to raise the next round, right?
Yeah.
Raise the next else. Probably.
I think the analysts, associates, and anybody, any layer below the partner, right? They are more often than not the champions of a deal, and the work that they do, the analysis, the convincing, is what goes on into decision making, right? So no, fair point.
I'd just like to add one more point, right? I mean, See, if you're like, if you start reaching out to investors, right, and not hearing it for the first time, second time, what I've seen work is if you keep sending monthly updates, right?
Yeah.
That typically works. So if I hear from a founder, say 3 or 4 months back to back, and there's been some progress or update in the business in terms of revenue or customers or product, that shows persistence. And then, of course, progress shows for itself, and then you definitely get a call in that case.
Yeah, actually, that's a very good point. I mean, very few founders do that consistently.
Yeah.
Like people start and give up. But yeah, I think that's a very good way to build top of mind recall in a way, right? Yeah, I think just one more thing that I'll add, right? Maybe in it works in very specific verticals like gaming that you look at a lot, Gaurav. Like the Discord channels are very active. Same thing, there are Reddit threads that are active in other areas. LinkedIn works as a very good channel. So if you are active in these channels, publish content, talk about your views, your product, chances are that you will get noticed because VCs also tend to look at these channels for their sourcing, their own sourcing, their outbound, right? So do not discount the power of content. Obviously, writing once a month is not going to help you, but being more active in those channels can help for sure. I'm not saying it will work for everybody, but at least in those specific verticals, it can work very, very well. So I think just on the one or two other things, right? Like on the reach outs itself, anything that you get put off by, not just on the inbound side, but anything that the founders should avoid doing.
I'd say like for me, like very long pitch decks typically go on back burner. If I see a pitch deck with say 20 slides, I say, okay, I'll read it when I have time, and that time never comes. Right? That is one. Second, more specifically on pitch deck, I see like a lot of founders emphasize a lot on the advisor network that they've built. To be very honest and like candid, nobody like really values that much. People value the founders and the founding team, not the advisor network, right? I mean, those are just photos on the deck. At least for me, that's the way I think about it, right? But and the other thing is like direct. I mean, I've got a lot of times I get cold inbound calls on my phone. Right now, while I appreciate the hustle of the founders, a lot of times it puts you off. Right? I mean, like, of course, you have to be courteous and you take that call, but that typically does not work well. At least for me, like direct cold call. Right? Seen that happening a few times.
Yeah, I think long pitch decks, it means that you are also not clear what messaging, what key things you stand for, especially when we are doing early stage, right? So there is anyway not a lot of numerical data or numbers, etc., that we are going through, right? My sort of, I think less than 10 slides, not just a slide number, but the way you're narrating the story, I think it becomes, again, it is all relevant for like a cold inbound, right? Otherwise, a lot of these exceptions you end up making if, let's say, the referral, as Gaurav touched upon earlier, right? Because there's some qualification that is done already in that way, right? But yeah, I mean, if you're looking at about what 100 emails or 100 inbound a week, you have to have some heuristic to filter through, right? I mean, sure, it could be wrong way to look at it, probably miss companies, whatever, good companies, good teams, but concise deck with a clear story, clear narrative. I agree, right? The whole advisor thing, of course, could be relevant in some cases, I guess, but usually it is not indicating anything
Yeah.
really, right? And again, within the deck, I mean, we can go into the details. I don't know if you meant that with the question, but crisp understanding of user problem, how are you better, if any proof points, etc., right? And all of that can be achieved really in less than 10 slides, because it is also indicating that you have taken the pain point to kind of make the thing simple to explain, right? Otherwise, like 30 decks basically is that you are kind of leaving it to the other person. And you leave that up, you can't, you're adding a point of friction in the process. So something to avoid.
Yeah. Now, coming to maybe the evaluation process itself, right? I mean, we look at different sectors here, but each sector will have its nuances. But some of the key things that VCs look at when they evaluate a very early stage company. I know one of your pet peeves is always like, is this VC fundable or is this not VC fundable? Maybe you want to talk about it a bit, like how do you evaluate that aspect and how important?
Yeah. So, I mean, for founders, I mean, whoever is fundraising, the most important question, I mean, one thing that I see quite often is the moment you do a startup, the first problem that you try to solve is fundraising, right? And that's not always right, right? You need to first figure out beyond the customer segment and the problem statement, do you really need funds? And if you need funds, I mean, of course, you'll need funds because they're doing a startup and bootstrapping it. But how much do you need, right? How much do you really need, right? I mean, I've met founders who have said that I'm going to raise 2 million. Why? Because I think that's the right seed check. I said, okay, that's the right seed check, but what are the use of funds? And people don't know that, right? So be clear with why do you want to raise funds and how much will you need to raise for the next milestone, right? So that I think is very important. Now, getting to like VC fundable or not, right? All businesses are great business, but not all great businesses are VC fundable, right? I mean, and we can dig deeper into that at some point, right? How VC maths work, right? But see, building a 100 crore revenue business is non-trivial, right? It takes a lot of time and effort, right, to get to 100 crore of revenue. But that may not be a great VC venture backable business, right? Because 100 crore business at max could be say 1,000 crore valuation in a very good case, which is like what 120 million valuation. Even if VC owns say 20% of the business, they'll make 24 million out of that, right? On a fully diluted basis. Now, for a fund size of say we are not a very big fund, say 120 billion, that is not a good return that we're expecting, right? While 24 million return by itself is big number, but for a $120 billion fund, which is again not a very big fund, that may not be material enough. So while building a 100 crore business is non-trivial and you have done that, kudos to you, but a VC may not back that, right? And that's where a lot of founders have that disconnect, right? I remember during EdTech era, I used to meet a lot of founders who were running their like profitable coaching institutions doing say 50, 60, 70 crore annual revenue and they wanted to raise VC money. I said, why? I mean, you're doing 60 crore revenue, you're making 6 crore profit, you're like doing things your own way. Why do you want to raise VC and dilute yourself? And then VC will ask you to go from 60 crore to 600 crore revenue. You even have visibility into that. But because everybody had that FOMO that, okay, my friend, he was doing something similar, he raised a 10 million round, so I should also raise that. So founders really need to question themselves that do you really need capital? And if you need capital, like how much will it make sense? And if it's not a business that can get to 100 million revenue scale and it can only get to say 10, 20 million revenue scale, then you look for those types of capital. It could be a family office, it could be a micro VC, it could be friends and family, it could be angels, right? So that's the way I think you should think about fundable, I mean, raising right capital from the right source.
Yeah, I think even now we see a bunch of very great businesses, right? It can be India focused technology, software, all of these companies, very profitable, 10, 15 crores revenue, but they do see the lure of VC and they think, okay, even we should be VC funded. No, fair. And in terms of just the evaluation, right? Like when a startup comes, pitches to you guys, the first pitch, what are the 3 to 4 things that maybe Pankaj, I'll ask you this. What are the top 3 to 4 things that you are assessing while the founder is pitching?
I think everybody has their own algorithm, I'm pretty sure. I mean, there would be areas where all three of us kind of look for similar things. There are areas we kind of differ, right? So for me, I think 2, 3 things kind of are non-negotiable. There could be additions on top of it, but 2, 3 things that have to kind of fall in place to do the second meeting, right? And I think we speak on the funnel, right? You touched upon kind of see what 1,500,000 companies a year, each of us talk to 300, 400. First conversation to second, at least for me, is about 20-25% in terms of funnel. I think we are also like similar level, right? So if you see a lot of the kind of drops happen between first conversation, right? And as if I look at the primary 2, 3 reasons, right, it is that either you don't have clarity on the problem you are solving, right, or the extent of it in customer's mind, or if you have that, then you don't know, like of course many customers might have related problem in some of the other sense, right? But who are you going after, right, particularly, right? And third, as a founder, what are your insights? It could be from working in the domain, it could be from getting some exposure to that area, industry problem, right? That makes you better suited to address the problem, right? It now, whether you're using tech or not to solve the problem is secondary, right? But really these three things, right? Do you understand the problem? Do you understand the customer who has the problem, right? Because all these are not just a theoretical exercise, it has implication. For example, do you understand the problem has an implication on what is the size of market that you're catering to, right? Do you understand the customer you're solving problem for has an implication on the GTM, that engine that you need to build, right? And Gaurav mentioned earlier, right, that not all good businesses are venture backable. Some like a nuance there is that VCs look for a replicability in the GTM motion, right? So have you figured the right customer? Can you reach out to them in a replicable, scalable manner over the course of 18 months post funding, at which point you can kind of raise the next round and continue doing that, right? And third is, as a founder, what is your right to win, right? Why are you a better team, right? If it's a good idea, good problem, valuable problem, 10 more teams will come, right? Why are you best suited, right? How do I answer that question? And again, it comes from, these are the questions you're seeking answers to, which is how, your sort of conversation, question, probing, understanding what inside, why, kind of surfaces. So these are like, three core things. Of course, you can have, if you're looking at AI, you kind of look at, what else is happening in competition, what else. But yeah, usually, I mean, at least if I summarize my 3 years, not long investing career, these would be the three common.
So the problem
pillars.
statement, the customer, and the right to win.
And the founder market fit.
The
you can
founder
call it,
market
or founder
fit.
like inside why is the victim. Yeah.
Got it. Got
I
it.
think at the stage that we come in, I would say that we index a lot more on the founder and the founder quality, right? And there again, more on not like pedigree and background, but like, are you the right founder in the founding team to solve a problem in this space, right? Because that becomes very important, right? Because at the stage that we come in, there's a lot of unknowns, like which way the market will evolve, how will your GTM work. But if you're a smart team and fit for that market, those teams figure out, right, the unknowns as well. Right? So that is, I think, what we index on a lot.
Yeah, and in terms of just the founder market fit, right? If any double click there, like who are the in terms of the pitches itself, right? If you can reflect back on a pitch and always thought, ki, okay, this is the right founder to build in this market, what would be the couple of things that stood out there?
First pitch is definitely the insights, etc. But first pitch is usually whatever 30, 45 minutes, right? An hour at max, right? At some point, of course, it meets the initial criteria, right? And you spend more time. So one, again, my mental model is that, are you learning something new about the market with every conversation, right? Let's say you decided to dig deeper, spend more time, maybe, meet rest of the team, ask follow-up question, go deeper in data, etc., right? Are you coming out with a new insight? It could be on the, nuance of a problem. It could be, why are these customers currently unserved or underserved, and in what way, right? What way the current solutions lack, right? Or what is the decision making process? Like, there's so much nuance in every conversation. As an investor, you have to be learning from the founder, right? So that depth, again, deeper, going deeper and deeper, again, not just at a surface level, becomes one criteria. But in the first pitch meeting, of course, you can only ask to kind of understand, right? And again, as I said, the idea really is for us as investors to figure where to spend time in terms of taking second meetings, right? And that's when some of these things probably make sense. But I look for that. I don't know if you have different.
Yeah, I think, you've covered that. That's what. So yeah, the founder market fit need not be just domain specific knowledge, right? You may have. So suppose you're building something in enterprise SaaS, B2B SaaS, right? And of course, you don't expect founders to have worked in that domain, right? But do you have something, because enterprise SaaS, for example, two things become important. One is your product, second is your GTM. So do you have some advantage in either of them? Are you very good at building a product, like enterprise grade product? Or in your previous role, have you figured out enterprise GTM, right? You may not be from that domain, may not be from BFSI domain, but have you sold to enterprises in other domains, right? That'll give you some insights on like some edge into like selling to enterprises in BFSI, right? So it need not be always domain specific market fit, but like, do you have the necessary things that are required to build a business, right? In that area that we're building in.
They also could vary. For example, I think you've done a lot of lending, right? So it's a different beast. Founder need to have a certain kind of experience. But for example, you have AI companion app. Probably a 23-year-old, Gen Z is better suited to, start and kind of think fresh, right? Versus somebody else, right? So I think every idea has its own nuance. But
Correct.
yeah.
Yeah, and BFSI, for example, at least in very specific spaces, right? If you have either worked in a fintech or in maybe say lending in some domain or the other, just understanding of how banks work, how regulators think, because that aspect becomes very important. And again, like you said, iterating, like are the founders iterating? Are they thinking through and coming back with better answers for your questions? I think that becomes important throughout, whether it's AI or BFSI or gaming or whatever it is, right? Yeah. So on the just on the evaluation coming back, right? How important of an aspect is storytelling? Because typically the difference between a founder who gets a second meeting to first meeting, right? Getting passed on the first meeting itself comes down to storytelling in some way or other. So, how important is it, and essentially, how do you, what tips would you give founders to better storytell?
Yeah, I think storytelling, if I look at, I mean, and we just spoke about the experience, right? Like 4 founders that I worked with, I think one common, and then they were successful in,
So this is just for everybody's context. This is
Taxi for
Taxi
Short,
for
Avel
Short.
Ladder, Swiggy, and Rupeek, right? All these 4 companies had, reasonable success, right? And if you talk to any of their founders, their ability to share their worldview in an engaging, compelling way, right, was a common theme, right? Of course, they had other, a lot beyond, but this was a very, very common theme, right? So it plays a very, very crucial part in various aspects, right? One is you're trying to bring about something that probably does not exist. There is not a set mental model for, whether it could be investor, whether it could be your employees, whatever, to kind of realize, right? I mean, as a founder, you have that vision, and storytelling is really communicating that vision, right? In a way that is relatable, that you can kind of see, happen, right? As an investor, you want to invest. As an employee, you want to join, right? So I think it is a very, very important aspect of it, right? I would say, a core skill set, right? There have been cases, where, whether it's my friends or whether people, who are very, very smart, very diligent, hardworking, probably have a good idea as well, but they're not able to, and it's probably not just the lack of communication, right? But for whatever reason, they're not able to, pass on that vision of the world, right, to others, right? And they're not able to they're not able to hire the right talent or attract right talent. So it comes with its challenges. I think storytelling kind of makes sense if you have the substance beyond it. So I think it's not like, of course we have seen cases where it's just storytelling and there's no substance. So that is also not good. So I think I would say if you have substance, the storytelling kind of makes your path towards that a lot more easier, even with all the complications that anyway come associated with entrepreneurial journey, right? So I don't know.
And one aspect, I mean, you covered most of it. One aspect of storytelling is like reading the room and then kind of adapting the story to the room, right? And let me like double click on that. So a lot of times you meet founders who are very passionate about what they do, right? And you can see that in the way they communicate. But then they're building something in deep tech or in a domain which is not very like obvious for somebody to understand, right? And that's where you lose interest, right? You can see the passion and the energy, but okay, I'm clueless. Why are you doing this? I don't even relate to this problem. I can't even figure out why this is a problem. So that becomes very important part, right? Because as a founder, like you're doing that day in, day out, so things may be very obvious to you. It may not be very obvious to the person who's like on the other side of the table, right? So just make sure that the other person understands what you're trying to communicate and try to like, and a lot of times, I mean, earlier in during interviews and school, we used to be asked, can you explain this to a 5-year-old kid or can you explain this to a grandmom? So do like kind of practice that as well, right? How can you simplify your story and the problem that you're solving if it is a complex area that you're building in? That becomes very important, right? You may be very passionate, but if you're not able to communicate that in a very simple way, then you lose that interest right there.
There also, I feel, because both of us have worked in consumer companies, I think generally it becomes relatively easier to kind of talk about it because you as an investor, you understand, right? And food delivery, whatever, taxi booking and all those are problems you can associate with fairly quickly. But as you go into some of the other domains might not be
Yeah.
that obvious. Yeah.
No, I think some of the founders also, at least this is a gap that I do see, right? They also do not think of the larger vision that they want to build and how do they change the world. Like, for instance, the TED talk that we do at the end of our IC. So, just for context, whenever there is a IC meeting that we have where we are making a decision of investment, we ask the founders to give us a TED talk of maybe 5 years later. Suppose you're successful, how would the world have changed? What would you have done? How would you have made the world better? So that sort of helps you in your vision thinking and assessment, right? Like, what is it that I'm building for? What is my goal here? I think just writing some of those things down, at least that is what helps me. I don't know if it will help everybody, but just maybe it doesn't have to be in a deck. Just writing a few things down, clarifying your own mental model before going pitching, I think can help founders. So yeah, at least my advice would be definitely do what Gaurav said, read the room, and also maybe write some of these aspects. Some people it will come naturally. Some people it's a learning curve, and I'm very sure if you have traction, nobody's going to ask you to story
Yeah, but I
tell.
don't know if it comes naturally, right? It takes effort. I mean, you look at, I think everybody's benchmark is Steve Jobs, but I've read a couple of books written by people who have worked closely with him. Before every WWDC or even iPhone launch, right? Which looked like it was done smoothly. Apparently, some 15 hours of just doing the same thing again and again went behind the doors. And there was, so.
Yeah, I think you need to take it seriously, right? Like you need to practice. Yes. And anything on the pitch deck itself, right? Any 4, 5 aspects that people need to cover.
So I think one is of course the team bit, right? I mean, why are you the right team to build in that domain or solve for that problem? That is important. Second, like just articulating the problem, like who's the customer, what is the problem, how are they solving it today, and how are they going to do it in a 10x better way. I think that is a very simple flow that typically works. Followed by, of course, your numbers and metrics and data and like traction, right? All those things generally help, right? And then, I mean, one thing that I see in a lot of, I mean, people do add competition slide as well, right? So there, I would say one thing that people, I mean, a lot of text that I see is you list a bunch of features on x-axis, you list a bunch of companies on y-axis, and everywhere else it is cross, and companies, yes, we have everything, right? So that's more a feature-driven differentiation, right? What I would like to normally see, I'm just talking specifically about the differentiation or the competition slide is, from a customer point of view, how is it important, right? Does the customer even care about those features that are listed there, right? Right. So from a customer point of view, if the customer has to talk about these 5 competitors, how would they see them, right? Not how are you seeing yourself against your competition, right? So that is more important when it comes to competition slide, right? Now, as I said before, advisor slide you may add, but adds no real value. Like unless you're building something in, say, deep tech and enterprise, they're having advisors from enterprise could make sense. But if you're building a AI companion, having an advisor, I don't know how it'll help.
Because nobody has built AI companions till now. So yeah.
So those are a few things that I kind of look at in pitch decks.
Similarly, I think less than 10 slides is what I like to see. That's like one.
Yeah. I mean, if you're sending a pitch deck, I would like to see 10 slides, when less than 10 slides ideally. But of course, when you're presenting, you can like have a longer slide and then cover the details of it.
And your slides should be communicating the story here. I mean, it's not that, I mean, I've seen various times where they're completely disjointed with each other, right? There's again, as Shivani said, right? Storytelling is what, and the slides are just the medium to communicate that, right? So, and here, of course, there are like broad areas that you should cover, but it could be like the flow could be different. Like all of that, I think is flexibility, but seemed like just like adding slides without really any story or a clear narrative coming out, right?
And slide deck is a filter. I mean, just before this, we were discussing that you passed on someone because the slide deck looked too messy, but then into referrals, you started to talk to them.
Correct.
Yeah. So I think AI tools do a good job. I think there are a lot of tools out there, guys. Just putting words on a PPT may not help. So maybe
But yeah,
some.
in this era of hype, I've seen companies just releasing fundraise doing like a 5 million round just on a one-pager Google Doc, right?
Yeah.
So it also depends on the market timing, the area you're building, and the kind of FOMO that you can drive.
Yeah, I mean, for all the gyan we can give, right? I think fundamentally it's also a function that what's happening macro, right? Which as a
Yeah.
founders you can't really control, right? Maybe suddenly you're in a space that is hot and you have VCs chasing those same VCs 6 months ago. You might be trying to reach out and you're getting ghosted, whatever, right? So at the end of the day, it's a black box, right? There are only few things that maybe you can kind of put together and but yeah, as I said, not Gaurav and Shivani also touched upon, not VCs not being interested or not being able to raise VC money is not an indicator on the quality of business, right? If you look at publicly traded companies today, even in India, US, maybe US, the dynamics shifting because VC has been around for a while. But India, if you look at it, I think I was reading some less than 1% or less than 2% of market value has been created by VC-backed companies, right?
Yeah.
Hopefully it will change.
Yeah, hopefully it will change, But yeah, point is, it's not an indicator whether
yeah.
it's a good business
Fair.
or not. Yeah.
And maybe I'll touch upon some topics that are a bit controversial, or even some of it which founders don't understand to that extent, right? Like one is early stage valuations, not ranges, but in general, how should founders think about negotiating valuations?
So it is, I mean, there are multiple factors that come into valuation, right? There is, at early stage at least, there is no,
I know it's
like
fresh of mind for you.
at early stage. I mean, there's no rationale to valuation, right? There's no quantitative approach, DCF, and like all of that, whatever multiples to
Those
valuation.
are anyways.
Yeah. Right? It's a mix of like, I mean, there's a function of supply demand, like a leverage, the other way of putting it, right? So typically, the way I think about it is every VC fund has certain check size that they, for example, in our case, we can invest anywhere between 1 million to 3.5 million, right? And at the first check, right? And then of course we have reserves for follow-on rounds. And we do want to get anywhere between 15 to 20, 22%, 25% in the company. So that kind of draws the boundary for us, right? If you're going to invest 1 million, we would want at least 15%. So that like sets the valuation to about 6.67%, right? At least, right? So that is one way. Now, similarly for founders, they have a certain amount that they want to raise and they have a certain dilution that they are comfortable with. And typically at early stage, when you're raising a seed round, it could vary anywhere from 10% to 20, 25%, right? Depending on the business, the space, the FOMO that's there in the market, right? So it's a function of these two things. And of course, you try to, in case there is some data, some revenue, try to triangulate it through like public market multiples, right? So suppose you're looking at SaaS business and suppose they're 500K revenue, and generally in that sector, public market multiples are say 10x. So at least 5 million is what you can easily give, right? Now, of course, you'll not give 5 million valuation in a lot of cases in the current market. So then you look at, okay, how do I triangulate it? I'm putting in 2 million. I want at least 20%. So gets you about 10%, 10 million valuation. Yeah. Founder says, no, I don't want to dilute more than 15%. There's somewhere you come in between 15 and 20, and that's how the valuation is set. Typically, right? This is how practically things are done. Of course, I mean, theoretically, you can do multiple other things.
Yeah, it's never about valuation, right? It's always about dilution, right? As founders,
Yeah.
dilution is a function of supply demand. You as a founder have sort of your input metric is really the fund like round size, right? Yeah. Whatever you are raising X, right? And you might have a point of view on how much dilution you're okay with. That's where supply demand kind of decides. Sure, if you have like 6 VCs with term sheet, etc., you probably have some leverage, right? You can get a good deal. If not, you kind of course, every VC or based on stage, etc., has some guideline in terms of how much ownership, entry ownership, etc., they want, right? But it's a broad range, right? But I mean, I guess like somebody is doing seed, but pre-seed, the range really varies from maybe 10-12% to 20%, right? Or something. It's a very broad range. So yeah, one metric you can really control is the fund raise amount, which Gaurav touched upon earlier, right? Kind of have a logical explanation, right, around why that much money makes sense at this stage of the company, and dilution really becomes a function of market dynamics, really.
And what, like any thing that you would want to talk to founders about even higher valuations at early stage, right? Because in the last, I think, 2 years, we have seen multiple companies which good businesses doing well, but overvalued. So any word of caution there?
So I think that at early stage, at least, and by early stage I mean seed, series A, don't try to over optimize on valuation, right? Because if you're playing a long game, you're not going to build a $30 million company, right? Your aim is to build a $3 billion company, right? So valuation at early stage, even if you dilute a little more or like take a little lower valuation, if you're building a really good business, that'll catch up and you'll make up for that as you build a large business, right? So that is one like general feedback. Second thing, what happens is, at least in early stage when you're raising a round, right? And just because you want to raise and you have got a term sheet at a high valuation, you may be happy with that. But when you go out to raise the next round, you have to justify the valuation for the next round. Let me give a simple example. Suppose you're very early stage and there's a lot of, like as Pankaj said, 6 VCs are chasing you and you have like literally no revenue, but you raise a 20 million valuation. Now, of course, next round when you want to raise at an up round, at least 40 million valuation, right? And suppose the market has changed, right? The sector that we're building is not as hot as it was a year and a half back. If you want to raise at 40 million valuation, people would want to see at least 4 to 5 million of revenue, right? I'm just putting some numbers here.
Yeah.
Now, to do that in 18 months, if you've done that, of course, you can command 40 million valuation, right? And people will happily give it to you. But in most cases, that doesn't happen, right? And so again, you're like in that loop, okay, I raise at 20 and raise at 40, but nobody wants to give you at 40 because the revenue is still 1 million, right? So you again are kind of hurting yourself by raising around the previous round at a very, very high valuation, right? So that catching up, of course, happens, right? So try to think through that as well, right? Think of it from a long-term point of view. You're building a company over the next 7, 8, 10 years, right? And you're going to build like a multi-billion-dollar company. So like 4, 5, 6 million here and there at early stage doesn't matter in the long run.
Yeah.
And also from a how do you pick VC's perspective? Like, what questions should founders ask? Suppose they have 2, 3 VCs who are interested, they have to pick one. Apart from valuation, which can be a way to decide, what other things should you optimize for? Because it's a long journey, right? It's not a 1 year journey, it's a 10-year journey.
Yeah, so I mean, at the end of the day, VCs are serving a very commoditized product, right? Which is capital, right? So that color of money is the same whether it's VC A versus B versus C, right? So as a founder, as you said, right, it's a 10, 12-year long journey, right? And I guess it's relevant for both sides, but as a founder, you have to really think, and especially at early stage, right, where the the journey is going to be probably haphazard. It's not going to be like to the top and to the right? It's going to be, it has its own ups and downs, right? So you have to really kind of do your own diligence, right? And we kind of during our process when we are in advanced stages of looking at a company, right? We actually push the founders to talk to our current founders, right? And it's the right mix. Some founders, of course, the founders who's, or the companies that have done well is one, but equally important, or probably more importantly, in the scenarios where probably companies have not done well, right? Because that's where you kind of see the real, partnership that emerges or that you get, or real support that you get from your VC, right? So founders should do that diligence. It's a long journey. And even before making that decision, right, asking questions around what are the areas in which you can help, right? Assuming that you're kind of comparing between multiple term sheets, right? Areas in which you can help, and usually these are, I would say, tactical areas, right? As a founder, you cannot expect the VC to solve like a strategic problem for you or solve GTM for you or all of that, right? Opening their network is obviously the lowest order thing. It could be in hiring, it could be in future fundraising and so on and so forth. At the very least, right, can you kind of really see the person to hear you out, listen you out, and maybe help you arrive at a decision just by listening to you, right? Because as I said, it's ups and downs, right? You probably need a sounding board just to kind of you think through, organize your whatever multiple pulling thoughts you might have going at a certain stage of the company. It's really that, right? Because that's what kind of defines. And I think some of the best relationships that I've seen have panned out have had that as a common factor. I don't know if you want to
Yeah, I mean, trying to have a joke that it's easier to get out of a marriage relationship than a
Seed-stage investor.
than a
Yeah.
seed-stage investor relationship, right?
Yeah.
So I think for every founder, you should take time. If you have like you're talking to multiple VCs and offer from multiple VCs, take time to really figure out who do you want to work with, right? I mean, valuation, as I said before, will like make up, right? Can you work with this like person, right? Can you have a on a Sunday afternoon if the person calls you, would you go out for a lunch with that person, right? I mean, are you comfortable at that level, right? I think that's the kind of VC that you typically should work with, right? Where you're comfortable sharing everything, right? Because
Sharing bad news.
sharing, yeah. I mean, see, company building is like it's not a smooth ride, right? You'll have ups and downs, right? So you want VCs who are there with you during downtime, because up times when things are going well, everybody and their mothers will be like cheering for you, right? But what really matters is who will be there when things are not going well. And as Pankaj said, like I'm sure every VC would ask for founder ref checks. You should ask for VC ref checks and big portfolio companies that you talk to, ideally companies that have not done really well, and talk to those founders. Now is the support from the VC when things are not going well.
Maybe talk to other investors who have been on the board of the
Yeah,
VC.
that is the other thing. And the other thing also, which is a little more tactical, but do look for like, are they going to support you in follow-on rounds, right? Because a lot of times, if things are not working well, you may not be able to raise external capital. So can they bridge you till you like reach a certain milestone when you can get external capital, right? So do look for VCs who have reserve capital to put in follow-on rounds.
Yeah, fair. And maybe just a couple of things, then I'll go on to one section that I have in mind. But ESOP, how much should a founder allocate at a seed stage? And maybe then I'll come to you with angels, right? Like, how do you think about angels?
So depends on the, I mean, at seed stage, typically some like rule of thumb number is 10%, you should have at least 10%. And if you have all the key functions filled in, right? Suppose there are three founders, one looks at tech, one looks at business, one looks at whatever, GTM and marketing or growth. Then you may want to like reduce that and like keep it to 8-10%, 8-7-8%. But if you have some critical functions which are missing, suppose again going back to the example of enterprise SaaS, suppose you're building an enterprise SaaS business and you don't have somebody who can do enterprise GTM, you may want to get somebody senior from the industry, right? And for that person, you may want to allocate at least 2-3%. Trying to really get some like a really good person to the team, right? So depending on what are the key functions which are vacant from a leadership point of view, you can like increase that or decrease that from 10% rule of thumb number.
Got it. And coming to you from how do you think about the investor set and specifically angel investors, right? In any round, like how do you pick angels? How many should you take?
You mean when we're looking
When
at a
you are
company in
looking
existing cap table?
not existing cap table, actually you can answer from that way also. But from a founder perspective, should I take angel investment? If yes, what sort of people? And from a cap table perspective, how many?
No, I think so. Obviously, I think the angel ecosystem has matured over the years, right? And whether it's founders, whether it's operators, whether it's not just operators with startup or rather new age companies, but even like let's say bankers, etc. You are seeing these people feature very frequently on cap tables, right? And I think it has a lot of advantage, especially as a founder, you have to really, I guess, one is relationship driven, right? Maybe your ex-boss or whatever, right? So that kind of is very, very obvious. But even outside of that network, if you as a founder see value in some of the other founder, right? Most of the founder make for good angel investor because they have kind of been through the grind, have the experience, can be your sounding board, etc. But some of the functional stuff can also be helpful, right? For example, a lot of fintechs that we have looked at, right? Smart founders have gotten like CXOs or retired CXO ex-bankers, right, as angel investors, right? Now, it's maybe 5-10 lakh 15 lakh amount here and there, so not and they obviously did not get them for the money, right? But obviously the experience, the ability, maybe connection, right? So that has its value. Having said that, as an investor also we look at that, we have unfortunately seen cases where the angel investor pool or angel investor allocation is like 10-15%, right, for barely like a couple of crores or maybe even less than that, right? So of course you don't want that complexity, or even, I mean, if I could say, that randomness on the cap table, generally it becomes a point of issue, right? If not now, then obviously moving ahead. So keep it clean. At our stage that we come in, which is typically again sweet spot is 1 to 3 million. More often than not, companies have raised maybe 1 or 2 rounds, right? One just family friend, second maybe could be a pre-seed kind of round. Anything beyond 2-3% pool for angel is kind of becomes a point of explanation, right? I mean, at least that's
I don't have too many lines on the cap.
Yeah, that's the other point. Don't have too many line items against angels, right? Because one, I mean, not because it looks ugly, but because I mean, a lot of time you have to get like
It does.
signatures from these people to like sign off
becomes
on the
a
next
operational
round.
overhead
It
for
becomes
you.
operational overhead. We may have an angel who has put in like 10 lakhs and he's like out on vacation for 15 days, and then you have to get something important signed from them.
Going forever.
It just becomes
And coordinating with 20 of them. So yeah.
So it has a value to answer in short, but yeah, don't complicate it. Right? Keep it neat and clean.
Yes. So maybe I'll do like just to end things, right? Like maybe 3-4 questions and each of you can take turns to answer. So any book that you
What
would
were we doing till now?
rapid, I don't want like long answers. I don't just one word or maybe one sentence answers.
Pankaj
I
is
lost
like,
my train of thought.
You're asking which book to him. Yeah.
Oh yeah, no.
How do you know?
He just said.
He read my mind. Okay. So yeah, book recommendation.
Book recommendations.
He'll have. Okay, go.
Yeah, you go ahead. I'll come back to it.
Nah, book. I mean, yeah, I'm reading what I learned about investing from Darwin, which I think founders.
Here's my book. Oh, okay.
Which I think while it's written by this gentleman Pulak Prasad who does public market investing, but I thought there were some, very good mental models in terms of thinking long term, etc. Which again we as investors can apply definitely, but as founders also could be helpful in getting your story, your priorities, etc. In place. So yeah, that's one a recent one. One very good book that I just finished reading is Apple in China. Again, different context, but basically the premise of that book is how the biggest company in a capitalistic world is basically captured by a completely opposite country, right? Where obviously Apple's manufacturing, etc. happens. Again, I guess a lot of brands are coming up which are probably reliant on not just China, but let's say very concentrated supply chain. They need to, they can learn a thing or two from here.
Yeah, I'd say like one book generally if you want to know more about like VC, how VC system ecosystem evolved, Power Law is like a good book to read.
Yeah.
The other thing, I mean, one other book which I would say is Thinking in Bets, right? So that's a very nice book. Why? Because as founders, right, whenever you make decisions, you don't have 100% information, right? And a lot of times you make decisions like based on either gut or like half information that you have. That book gives you a very good insight into how you should think about decision makings, right? A lot of times we judge the decision based on the outcome, right? Whereas decision is made before the outcome has happened, right? And when you're making a decision, you're making the right decision. How do you make the right decision with limited information without worrying about the outcome, right? Outcome is like secondary. So how do you make the right decisions? I think that's a great book, Thinking in Bets.
Equally
It
relevant
comes
for both investors and founders.
both investors and founders, yeah. So it brings in from angle of poker, right? How decisions are made.
Nice.
बाकी चाचा चौधरी वगैरह तो कह नहीं सकते थे
No, for light reading can be done. Any podcast recommendations?
You know the favorite that we have, right? But yeah, I mean, I'll skip that. But one thing, generally got curious about how some of the, funds are made, right? I mean, more closer to what you kind of do professionally. And Samir Kaji runs this podcast called Venture Unlocked, where he gets more. I mean, of course, they have founders, operators also, but his typical audience is a new emerging manager or a recent manager who has his or her own learning of setting up a fund, right? Why are they doing it? What approach? What different way, etc. They're doing it. I think that is, kind of listening to that. Of course, acquired.
I think everyone acquired is one. I think Masters of Scale is like a good one.
There's Reid Hoffman, no?
Reid Hoffman, yeah. Then there is
Founders is also pretty good.
Founders is good. Yes.
There's one gaming focused Gamescraft. No, I'm forgetting the name. But
Yeah, but I know which one you are talking about.
Yeah.
That's the Anderson. It's a VC plus
Yeah.
this thing. I'm forgetting the yeah. Uh,
What else? Your favorite book? Or whatever, book recommendation, not favorite book.
I would say measure what matters is pretty good. Also, I don't know if relevant for founders, but just in terms of keeping yourself calm and figuring out that it's a long journey. I think I recently reread Siddhartha also, which is again very helps. I can think, I can wait, I can fast, right? I think it has even that sort of patience is something that founders also need to learn. So yeah, I would recommend some of these. Podcast wise, if somebody is looking for something very different, Empire is a very good.
I finished last week. Pretty
Yeah.
good.
So
We actually did Gamecraft podcast. I mean,
It
we
is
have a
great.
Gamescraft company in India as well, gaming company, and the podcast is Gamecraft.
got it. Great. No, thank you so much, guys, for taking the time. Hopefully, it's helpful for the founders and we won't get any flack. So,
Shivani, please share something controversial about VC. So, I mean, let me ask you this question. Like, you've been a banker before, right? On buy side or sell side? Basically.
I mean, it is sell side.
You are
When does it say? Typically, I had by startups, no?
No, yeah, hired by startups.
Okay.
Yeah.
So you've been a banker before, then you worked in like a corporate VC setup before, and then you got into VC. So, like, what do you like or like, what do you hate about VCs?
What do I hate about
Yeah.
VCs? Okay. I have to think. Uh,
Need some desi answer, yeah, not a sophisticated one, right?
यार मेरे को पता नहीं है मैंने पूरे जिंदगी यही किया है तो अभी
Okay, let me put it differently. Like at Avendus, when you're a banker, what was the impression of VCs that you had, or like investors?
Yeah, that's a good question.
I think I used to talk to a lot of growth investors back then. मेरे को लगता था यार कितना एनालिसिस करेंगे like डेटा का 10,000 कट like it was cohorts by this, cohorts by that. I'm like, how is this going to change your decision making? So I never at that point appreciated the decision making process of a VC. I still sometimes reflect on my own decision making and feel that it's, it takes time. There are so many variables, but still, as a banker, that was very annoying to me. Like
Same
getting
question,
data requests
but
at
instead
11.
of investors, what did you not like about the founders for whom you were raising? You would have interacted with
No,
them.
I'm not going to answer that question.
This last part of
Okay, one question to all. I mean, I can also answer this, but like, how much of like investment, like VC investment, do you think is skill versus luck?
Skill versus luck. I would say 50-50. I do
Yeah.
think it is. Actually, no. I would say 70 skill, 30 luck.
How about you?
Yeah, I would say, of course, like if you look at it, right? I mean, even the best, most successful VCs have probably gotten 2 or 3 companies right. You look at whatever, maybe Bill Gurley is the name, right? Or I don't know the gentleman before Bill Gurley, right? Or
Sequoia,
Mike Moritz, right?
yeah.
Literally gotten 2 or 3 right. Of course, like luck plays a big factor, but I mean 2 or 3 like really, really right. Of course, they might be like relatively smaller wins, etc. Luck plays definitely a factor, right? If we are talking that scale, like 20 years, 2 companies, right? But I think it's equally likely to miss those 2 if you don't have right process in place, right? So I guess right some work, some system around it. Again, I think you only told me or somebody said right that VC opportunity is a domain where you get to know you were bad at it after 10 years, right? So I guess, right? I mean, luck is, and any aspect or any endeavor in life is important, but having right system,
Yeah, I
the
think
right input
patience.
is-
I feel like it's the other way around, 70% luck, 30% skill, right? Because all the successful companies that you look at, right, the journey that they have charted, right, not only in India, but even globally, right,
It has
it's
been
very
a
different
bumpy.
from what they started off with, right? So if you underwrote that on, this is what the company will be
Yeah,
doing.
including like something like Google, right?
Yeah.
For example, they used to be like a B2B company, right? The whole shit has
Yes.
never even happened, right?
Yeah.
You're
Or
right.
like Facebook, right? It was the Facebook or campus thing, and then from there it picked up, right? So, I mean, of course, you need to be at the right place at the right time, and you need to have a prepared mind. That's where the skill factor comes in. But how the company will pan out is There's very little that you can control that.
Fair.
Control over that.
Cool. No, thanks, guys. Thanks for listening in. That was us signing off here.
Dear listeners, thank you for listening to this episode of the podcast. Subscribe now on your favorite podcast app for free, and you'll be the first one to know when new episodes are available. Just search for Prime Venture Partners Podcast in Apple Podcast, Spotify, Castbox, or however you get your podcasts. Then hit subscribe. And if you have enjoyed the show, we would be really grateful if you leave us a review on Apple Podcast. To read the full transcript, find the link in the show notes.